Hello, everyone. Welcome to Talk Talk Speak podcast. Today on the deep dive, we're tackling a truly fundamental question. How does the power of a country's money shape the world we live in? We've got a fascinating report here. It's called Shahasensu, that's Currency Hegemony and World Order, and we're going to pull out the most crucial insights for you.
Yeah, this report gives us a really solid foundation. It helps us understand how a dominant currency, well, it isn't just about economics, is it? It's deeply tied to global political power. We'll be looking at the history, the sort of economic logic behind it all, and, what the future might hold.
Exactly. And our goal in this deep dive is, well, to cut through some of that complexity. We want to give you a clear sense of what makes a currency a global powerhouse, how that's shifted over the years, the current role of the U.S. dollar, of course, and the forces that could actually lead to change. We're aiming for those aha moments, things that help you see the world economy in maybe a whole new light. Okay, so let's dive right in. What exactly is currency hegemony?
Well, at its core, the report really hammers home this powerful idea. Whoever dominates currency dominates order. Simple as that, almost. And by world order, we're talking about the basic structure of power, the authority that kind of shapes how countries deal with each other globally. As the report points out, this isn't exactly a new idea. Its roots go way back, centuries even. The Treaty of Westphalia in 1648, that was a key moment in setting up the modern state system we know.
So it's way more than just exchange rates and interest rates then.
Right.
Currency is actually a tool for global influence.
Precisely, yeah. The ability to issue money that everyone trusts, that they use internationally, that's a fundamental source of national power. It really affects everything, from who can trade easily to who holds the leverage in big international talks. The report makes a strong case that currency power both reflects and reinforces the global political scene.
That makes perfect sense. So what are the key ingredients? What does a currency need to sort of rise to the top and become dominant? What does it actually take?
The report lays out several factors, and they're all kind of interconnected. First off, you need a strong economic foundation. We're talking a large, stable economy, one that's deeply involved in global trade. Think about the U.S. economy, its sheer size, its relative stability. That gives the dollar a huge leg up.
And when there's high demand for a currency, that gives the issuing country some pretty significant perks, right? Like easier borrowing.
Absolutely. High demand means that country can borrow more easily, and usually at lower interest rates. That gives it a lot more flexibility, both at home and abroad. And it's quite striking. The report reminds us the dollar is still used in over 80% of global trade finance.
80%. That's a massive figure. Okay, so a strong economy, that's crucial. What's the next piece of the puzzle?
The second vital component is mature financial markets. These markets need to be lots of trading activity. They need to be liquid, easy to buy and sell assets quickly. And they need to be open, accessible to international players. The U.S. Treasury market is, well, the classic example. Its size and liquidity make it the go-to place for central banks to park their reserves.
The report mentions something called liquidity-based theory. Can you break that down a bit? What's the core idea there?
Sure. It's basically the idea that companies, well, they prefer to issue their debt in currencies where the markets are most liquid. Think of it like this. If you want to sell something fast, you go to the busiest marketplace. Right? Same logic applies to financial markets. And when more debt is issued in a currency, its markets become even more liquid. That attracts more borrowers, more investors. It creates this kind of positive feedback loop, a virtuous cycle. We've seen this play out historically, with the Dutch guilder, the British pound, and then, of course, the U.S. dollar. And the report really stresses that governments need to actively work to maintain these deep pools of safe assets in their own currency. It doesn't just happen.
Right. So it's not just about having the money. It's about having a really reliable, efficient plumbing system for it all to flow through.
Got it. What else is essential for currency dominance? Well, geopolitical influence and institutional trust are also absolutely key. History shows us that financial power often follows political power. You look at the Roman denarius, the Dutch guilder, the British pound, their peak dominance coincided with their nations holding significant political clout. Military power can also play a role, sort of indirectly, by ensuring goods and capital can flow freely. That builds confidence in a country's financial setup.
The report gives that really interesting example involving the U.S. and Saudi Arabia, doesn't it?
Yes, exactly. That agreement where the U.S. provides military protection and in return Saudi Arabia prices oil in dollars, that's a classic case of political and financial power working hand in hand. But it's not just about military might. Strong, transparent institutions, sound regulations, no arbitrary capital controls. These are fundamental for building and keeping international trust in a currency. Nobody wants to hold on to a currency if they think their access might suddenly be cut off, right?
Right. Trust and stability, they're paramount. Okay, what about this idea that once a currency is dominant, it's just really hard to displace, like everyone's using it, so why bother switching?
Ah, yes. That's the power of network externalities and inertia. Once a currency is widely used, it just becomes even more stable, more liquid, which naturally attracts more users. It's that classic chicken and egg thing. Widespread use makes it very costly and, frankly, inconvenient for any single country to try and switch to something else. The dollar's position in global finance is a bit like English in international communication. Its sheer prevalence creates this powerful inertia. It's like trying to get everyone to suddenly use a totally different keyboard layout. The switching cost is just too high for most.
That makes perfect sense.
Yeah.
And finally, the report touches on technology and innovation as another driver.
Absolutely. Throughout history, you see financial technology advancements playing a really crucial role. Take the Dutch bank florin back in the 17th century. It gained prominence partly because its ledger-based system offered, for its time, superior liquidity, much easier than moving coins around. Today, the efficiency, the reliability of a dominant currency country's payment systems, its financial institutions, these are critical parts of the global financial architecture.
Okay, so it's this potent mix then. Economic strength, well-oiled financial markets, political clout, institutional credibility, that stickiness of widespread use, and a knack for financial innovation. It's no wonder it's such a huge challenge for a new currency to break into that top spot. All right, let's take a trip back in time. What were some of the early currencies that held significant sway?
Yeah, the report walks us through a long history, starting with early regional powers. You had currencies like the Greek drachma, the Roman denarius, the Byzantine solidus, the Islamic dinar, and later the French franc. Then, maybe from the 13th to 16th centuries, gold-backed currencies like the Venetian ducat and the Florentine florin became preferred for international trade, especially between Europe and the Middle East. Gold was stable, easy to transport, relatively speaking.
And then comes the Spanish silver dollar. The report calls it the first truly global reserve currency. What made it so dominant?
It was really the massive flood of silver coming out of the mines in the Americas, starting in the 16th century. That fueled its rise. It became the dominant currency across Europe, Asia, the Americas, lasted for several centuries. Think of it as the first currency with a truly worldwide reach, backed by those vast silver reserves.
Okay, so moving forward chronologically, the report highlights the Dutch guilder as being particularly important, especially with this idea of financial innovation emerging. Tell us more about that period.
Right. The 17th century was a real turning point with the Dutch guilder. A key development was the establishment of the Amsterdam Bank in 1609. They introduced the bank florin, which was essentially an accounting unit held on the bank's books. This was pretty revolutionary. It allowed for quick, basically cost-free transfers between accounts without needing to physically move coins, check their weight and purity, and secure them. It provided unprecedented liquidity for the time.
So it was almost like an early form of digital money, in a way.
In a very basic sense, yeah. This superior liquidity, plus the Amsterdam government's strong commitment to backing the bank's reserves, it propelled the guilder to a dominant position. And this happened even though the Dutch economy itself wasn't the largest. It really underlines how financial innovation can sometimes trump sheer economic size in achieving currency dominance. But, as the report notes, the Fourth Anglo-Dutch War in the late 18th century really shook confidence in the Amsterdam Bank, and the guilder's influence started to fade. It shows how geopolitical shocks can undermine even the most innovative systems.
That's a great example of how interconnected all these factors really are. Okay, next up in history, we have the British pound and the era of the gold standard.
Yes, the 19th and early 20th centuries, that was the sterling era. This lined up with the peak of the British Empire, its Industrial Revolution, and London becoming the world's undisputed financial center, banking, insurance, commodities trading, everything. At its peak, something like over 60% of global trade was conducted in sterling. That's huge. And crucially, after the Napoleonic Wars, the British government built up this strong reputation for, fiscal responsibility, credible governance, that allowed them to issue large amounts of safe pound-denominated debt. The period from roughly 1816 to 1914 is often called the first era of real globalization, and the gold standard, with sterling right at its center, provided a relatively stable international money system.
So what triggered the pound's eventual decline? What paved the way for the U.S. dollar to take over?
The two world wars, they were the major turning points. They massively weakened the pool of safe, liquid sterling assets because Britain just racked up enormous debts. At the same time, the United States came out of those wars with its economy vastly strengthened. It had the largest, most liquid market for safe government debt, and importantly, a unified national currency system under the new Federal Reserve.
And that naturally leads us to the Bretton Woods system. How did that formally put the dollar on top?
Right, the Bretton Woods Agreement in 1944, that really cemented the dollar's central role. It set up a system where other major currencies were pegged to the U.S. dollar, and the dollar itself was convertible to gold at a fixed rate, $35 an ounce. This system also created the IMF and the World Bank, institutions where the U.S. and its European allies, well, they held most of the sway. But, persistent U.S. trade deficits in the late 60s, early 70s, they started to erode confidence. Could the U.S. really keep converting all those dollars back to gold? Ultimately, that led President Nixon in 1971 to suspend the dollar's convertibility to gold, the famous Nixon shock.
But even after Bretton Woods collapsed, the dollar didn't really lose its top spot, did it? How did the U.S. manage that?
That's a crucial point. The U.S. managed to maintain the dollar's global dominance largely by engineering the petrodollar system in the 1970s. They struck strategic deals, especially with Saudi Arabia and other OPEC nations. The core agreement was that oil would be priced and traded in U.S. dollars globally. In return, the U.S. offered military protection, access to U.S. markets, that kind of thing. This created this constant, massive global demand for dollars because any country needing oil had to get dollars first. And then the oil exporters took their surplus dollars, the petrodollars, and reinvested them, often back into U.S. Treasury bonds and other dollar assets. This just further locked in the dollar's position. Even today, the report states around 80% of global oil deals are still done in dollars. So even when the formal gold link broke, these underlying structures kept the dollar firmly in the center.
Looking back at that history, it really seems like major global shocks, often wars, tend to weaken the incumbent currency and create an opening for rising powers, especially those with, stronger financial depth and stability and financial innovation and institutional credibility. Those seem to be recurring themes throughout all these transitions.
Exactly. And the way the petrodollar system was established after Bretton Woods, it shows something really important. A dominant power can actively adapt. It can implement strategies to maintain its currency status, even when the whole international monetary system shifts underneath it.
All right, fascinating history. Let's bring our focus right up to the present now. The U.S. dollar, clearly still the dominant force, but what does the current global currency landscape actually look like? And what are the main challenges the dollar is facing today?
Yeah, despite all the talk, about potential shifts, the U.S. dollar remains the undisputed leader, no question. It's still the primary reserve currency held by central banks globally, and it's the most widely used currency for international trade, hands down. As we mentioned, it underpins over 80% of trade finance, and a huge chunk of global debt, something like 64%, is denominated in dollars.
The report includes some really helpful tables that illustrate this quite clearly. Let's look at Table 1 first, the one on global official foreign exchange reserves. What are the key trends jumping out there?
Right. This table uses IMF data showing what currencies central banks are holding. And you can see while the dollar's share has gradually slipped, it was over 70% back around the turn of the century. Now it's around 57.8% in late 2024. It still massively outstrips everything else. It tells us that central banks overall still see the dollar as the most stable, most liquid place to park their international savings, basically. The euro is in second place, then you've got the yen, the pound, and the Chinese renminbi showing, a modest but growing presence. These reserves are a key sign of trust, a measure of stability and liquidity.
Okay, and Table 2 shifts focus to the share of currencies in the global foreign exchange market turnover using BIS data. What does that tell us about the dollar's role in, day-to-day transactions?
This table, it really hammers home the dollar's central role as the main vehicle for exchange internationally. In 2022, the dollar was involved in an incredible 88.5% of all foreign exchange trades. Now remember, each trade involves two currencies, so the percentages add up to 200%. But still, 88.5% is huge. The euro is way behind at about 30.5%, then yen, pound, and the renminbi down at 7.0%. This data just underscores the dollar's unmatched liquidity. It's the workhorse of the global economy when it comes to actually making international payments and trades happen every single day. Even if reserve holdings are slowly shifting transactionally, the dollar is king.
So the dollar keeps benefiting from what people often call the exorbitant privilege. Could you just quickly remind us what that actually means?
Sure. That term was coined famously by a French finance minister back in the day. It basically refers to the unique advantages the U.S. gets because its currency is the world's main one. This includes being able to borrow more easily, more cheaply on global markets. And it gives the U.S. this very powerful tool of imposing financial sanctions. Effectively, the rest of the world pays the U.S. a small premium just for using its money. But, as the report also points out, there are potential downsides too. It can make U.S. exports less competitive, and there's always the risk of backlash of other countries looking for alternatives if sanctions are seen as being overused.
Okay, so the dollar's still clearly on top. What about the euro? It is the second most important currency globally, isn't it?
Yes, the euro holds that solid second place. It accounts for roughly 20% of global reserves. It's also used heavily for invoicing trade within the Eurozone itself. About 60% of their exports, 52% of imports in 2023 were in euro. The European Central Bank sees the euro's international role as pretty stable, although it does face challenges like lower interest rates compared to the dollar recently, and various geopolitical things influencing reserve managers. But a key thing holding it back from really challenging the dollar as the top reserve currency is the lack of a single, unified, massive market for safe government bonds, like the U.S. Treasury market. There's no single Eurobond market of that scale.
Right. And what about China's renminbi? There's always so much discussion about its potential to become a major global player. Where does it stand?
Well, the international use of the renminbi, the RMB, it's still pretty low when you compare it to the sheer size of the Chinese economy. It accounts for maybe 2.5% of global currency usage overall, compared to, 66% for the dollar? So a big gap. However, China has been actively pushing the RMB internationally through various strategies. They've set up offshore RMB clearing banks, launched their own payment system, CIPS, though it's important to note CIPS still relies heavily on the SWIFT network for messaging, and its daily volume is way lower than systems like CHIPS in the U.S. They're also part of the mBridge project for cross-border digital currency payments, expanding bilateral currency swap lines with many countries, and encouraging trade settlement in RMB, like deals with Brazil and Argentina.
But there are still pretty significant hurdles in its path, aren't there?
Absolutely. Big ones. The RMB faces challenges because of China's managed exchange rate, its capital controls, meaning money can't flow freely in and out, and just ongoing concerns about transparency and trust in its financial system and institutions. And interestingly, the report notes that recently the People's Bank of China seems to be prioritizing exchange rate stability, maybe even more than pushing aggressively for further internationalization right now.
The report also includes a table, Table 3, with specific indicators on RMB internationalization. What are some key takeaways from that data?
Yeah, that table shows that while the RMB's share in global payments has seen some growth, maybe reaching around 3.5% to 4% in early 2025, its slice of official foreign exchange reserves is still quite small, around 2.2% in late 2024. Its share in global trade finance is about 5%, which puts it behind both the dollar and the euro. So overall, that composite international usage figure is estimated around 2.5%. And while the USD-RMB pair is the fourth most traded in the FX market, the bigger picture suggests that, despite all the de-dollarization talk, the dollar's dominance across these key metrics remains really substantial. Those network effects and the sheer depth of U.S. financial markets are hard to overcome quickly. China's approach seems very gradual, very state-led, and clearly prioritizes keeping domestic stability first and foremost.
So yeah, despite the buzz, it sounds like the dollar's reign isn't exactly ending tomorrow. But there are definitely forces swirling that could reshape things down the line. Let's talk about those variables, those winds of change. The report highlights geopolitical shifts like de-dollarization efforts and the growing influence of the BRICS plus group.
Yes, and the reasons behind this de-dollarization push are pretty diverse. Countries want to reduce their reliance on the dollar to avoid risks, things like U.S. sanctions exposure, potential debt traps linked to dollar borrowing, currency crises, maybe even a perceived loss of sovereignty. And the increasing use of the dollar as a tool, the weaponization through sanctions, that's become a really significant catalyst pushing countries to look for alternatives. The BRICS nations, especially now with their recent expansion, are really becoming a focal point for this. They're increasingly trying to use their own local currencies for trade and finance amongst themselves and with other global south countries. I mean, their combined population, energy reserves, manufacturing output, it's considerable now, actually surpassing the traditional G7 industrialized nations on some measures.
And they're not just talking, they're actively trying to build their own financial infrastructure too, right?
Exactly. Things like BRICS Pay or the mBridge project for cross-border payments using central bank digital currencies, these are aimed squarely at creating alternatives to the existing dollar-dominated system. Their own new development bank has also committed to doing more lending in local currencies. And the expansion of BRICS to include countries like Thailand, Malaysia, Indonesia, Algeria, that could add more weight to these efforts. Interestingly, the report suggests that U.S. policies themselves, sanctions, tariffs, might actually be, perhaps unintentionally, speeding up this de-dollarization trend. And you look at projections, emerging markets are expected to be over half the global economy by 2050. That growing economic weight could eventually translate into more currency influence. So, yeah, de-dollarization isn't just one thing. It's a mix of strategic goals countering U.S. influence economic goals, getting more policy space, fairer trade, and reactive moves just trying to get out from under sanctions.
Fascinating dynamics there. Okay, another huge factor the report emphasizes digital disruption. We're talking central bank digital currencies, cryptocurrencies. How might these technologies shake up the monetary landscape?
Right. Central bank, digital currencies, CBDCs, they definitely have the potential to modernize payment systems. They could make cross-border transactions faster, cheaper, more transparent, and potentially boost financial inclusion, too. The IMF estimates something like 130 countries, representing almost all global GDP, are exploring CBDCs in some form. That's huge. But widespread adoption could also have big implications for how monetary policy works, for financial stability. You could see issues like bank disintermediation, where people pull money out of commercial banks, plus new operational risks for central banks themselves. China's ECNY is probably the most advanced large-scale example right now, and that mBridge project is specifically looking at multilateral CBDC platforms. But the challenges for cross-border CBDCs are significant. Designing them to work together, interoperability, getting the regulations right across different countries, it's complex.
And what about cryptocurrencies and stablecoins? They often get talked about as potential bypasses for the traditional system.
They certainly offer potential ways around the traditional dollar-centric financial plumbing, yes. Stablecoins especially have seen explosive growth. Their total transfer volume in 2024 apparently exceeded Visa and MasterCard combined, though it's crucial to note that the vast majority of these stablecoins like Tether, USDT, and USD Coin, USDC, are actually pegged to the US dollar. So the report highlights this really interesting potential dynamic. If the US manages to effectively regulate these dollar-pegged stablecoins, it could, maybe counterintuitively, end up strengthening the dollar's digital dominance. On the flip side, if stablecoins pegged to other currencies take off, or if truly decentralized cryptocurrencies gain traction, then yes, that could contribute to de-dollarization. But of course, there are still huge risks with all these digital assets. Regulatory uncertainty is massive, transparency issues persist, like with Tether's reserves, potential for illicit use, and consumer protection worries. So this whole digital currency revolution, it could go two ways. It might fragment the international monetary system, or it could actually reinforce the existing power structures if the dominant players adapt and regulate effectively.
The report also brings in the role of the wider geopolitical chessboard. Great power competition, the use of sanctions again, economic statecraft. How does that all tie into currency dominance?
Well, the increasing use of financial sanctions by the U.S., like major ones against Russia, it undoubtedly pushes not just the targeted countries, but others too, to actively look for alternative financial channels. They want to reduce their vulnerability. So this trend can definitely accelerate de-dollarization and spur the development of those alternative payment systems we talked about. And the broader strategic competition, especially between the U.S. and China, it now clearly extends into currency and technology. Trying to internationalize your currency, developing digital currencies. These are becoming tools of statecraft, part of the competition. And while weaponizing the dollar with sanctions might seem like a powerful tool in the short term, the report suggests it could be costly long term. It incentivizes alternatives and could slowly erode the dollar's image as a neutral, reliable global reserve asset.
Right. Finally, the report looks inward a bit at the resilience, but also the vulnerabilities of the incumbent, the U.S. dollar itself. Thinking about U.S. economic health, policy choices.
Yeah, the dollar's dominance has allowed the U.S. to run large deficits relatively cheaply. That's the exorbitant privilege again. But there are potential vulnerabilities, things like uncontrolled government debt increases, the growing U.S. net foreign debt position, or any perceived weakening of U.S. institutions. Think about those debt ceiling standoffs, or fears about the Federal Reserve becoming politicized. Those things could erode international trust in the dollar over time. And that gradual decline in the dollar's share of global reserves over the last couple of decades, while slow, is a trend worth watching. Plus, how the U.S. chooses to regulate digital assets, especially stablecoins, that could be crucial. It could either help solidify the dollar's dominance in the digital age or, if handled poorly, risk ceding leadership. Ultimately, the report concludes that while emerging markets' economic clout is growing, turning that into real currency influence takes more than just size. You need those deep, liquid, trustworthy financial markets. And you need a willingness to accept the responsibilities and maybe the downsides of having a major international currency like your currency appreciating, dealing with volatile capital flows. That's something countries like China have seemed cautious about, hence the reluctance to fully open their capital account.
Okay, so bringing this all together then, this deep dive into currency hegemony and world order, it's really painted a picture of a complex, constantly shifting landscape, hasn't it?
Indeed. We've gone through those fundamental conditions, the strong economy, the robust financial markets, geopolitical influence, trust, those powerful network effects. Factors the U.S. dollar has benefited from for a long time.
But the report makes it pretty clear that the dollar's dominance, while still very significant, is facing more headwinds now. And we are seeing that slow but noticeable downward trend in its share of global reserves.
Exactly. Geopolitical shifts, that de-dollarization push, the rise of BRICS plus technological disruption from CBDCs and stablecoins, and just the strategic jockeying of major powers. They're all feeding into this evolving picture.
It sounds like we're probably heading towards a more multipolar currency world, although, as you said, the dollar is likely to remain maybe the primary currency for quite a while yet, just because it's so deeply embedded in the system.
Yeah, a more probable scenario than, say, the RMB suddenly taking over tomorrow is probably the increased use of regional currencies or maybe currency blocks for certain types of transactions, perhaps within groups like BRICS for their internal trade, for example.
In a more fragmented currency system, well, that could bring its own challenges, couldn't it? Maybe higher transaction costs globally, perhaps more financial volatility, more complex geopolitical map. Maybe more distributed power, but potentially less overall stability.
Which raises a really interesting final thought, something for you, the listener, to maybe chew on. Could the whole concept of ordering the world through currency dominance, could that itself start to evolve? As financial power gets more spread out, or as technology leads to more decentralized forms of money, could that ultimately reduce the ability of any single nation to unilaterally shape global order through its currency? That transition period, well, it's likely to be uncertain, maybe unstable. It really requires us to watch these trends closely and prepare for a global monetary future that looks potentially more diverse, more dynamic.
Some truly profound insights to wrap up on there. Thank you for joining us. See you next time.